Thank you, everyone, for being here. My name is Sree. I'm here from Scottish Oriental Smaller Companies Trust, which is an investment trust that focuses on investing in smaller companies in Asia. In the presentation today, I will broadly cover 5 topics, starting with the investment philosophy and process of the trust. I will then touch on how the portfolio is positioned today, and I will talk through some company examples, some holdings in the portfolio, which will bring to life this investment philosophy and process. I will briefly touch on a couple of changes that have happened in the mandate of the trust, which we believe have been very beneficial in recent years. And lastly, I will touch on the performance outcomes which we have seen in the past, as well as what you should expect as shareholders of the trust. Now, starting with a bit of an introduction, Scottish Oriental was established in 1995, and since inception, the team that has managed the trust has remained the same. It was set up under Angus Tulloch, who some of you might know, as Stuart Ivory, and then leading First State, which is now the team known as FSSA Investment Managers, which I'm a part of. What has changed since 1995 is the definition of what constitutes a smaller company. So when the trust was established, a smaller company was defined as a business with a market capitalization of $500 million or less. But as Asian companies have seen considerable growth over this period, this definition was extended to $1 billion, $1.5 billion, $3 billion, and as of today, it stands at less than $5 billion at the time of first investment. But what has stood the test of time through this entire period has been the investment philosophy and process, which has stayed the same. Now, had you invested at the time of inception, say £100, that £100 would have compounded to £1,550 today, compared to just over £200 in the MSCI AIC Asia Pacific Index. So it has been a satisfactory outcome over the long term. Now here we have, this has actually taken the investment philosophy from our first annual report in 1995. And this investment philosophy has stayed exactly the same as the team has remained unchanged. The key attributes of this philosophy are, firstly, we as a team are bottom-up stock pickers. What this simply means is that we don't spend time trying to predict the direction of interest rates or where currencies will go, and then use those predictions to find winners or losers. Instead, we try to find the best quality businesses among smaller companies in Asia that have a track record of doing well irrespective of the macroeconomic environment or the regulatory environment in the region. Secondly, we as investors are completely index agnostic. So the portfolio that you see is entirely a residual outcome of bottom-up stock selection in terms of the country or the sector weights. Just because a company is held in a particular index or a particular country is in an index with a certain weight, we see no reason to own it. Thirdly, as investors in smaller companies, we would like to own small caps that have the potential to be the larger companies of the future. There are 3 things that we look for. Firstly, owners and management teams who we feel aligned with as minority shareholders in terms of their governance standards and how they have treated various stakeholders. Secondly, business franchises that consistently earn high returns on capital. Because for us, that is the expression of the strength of the franchise over the long term. And finally, a business that today may be small, but operates in a category that has the potential for significant growth and has a dominant position in that category. So as that category grows, this business has the opportunity to capture a large share of the incremental profits of that category. In terms of valuations, our firm was founded in Edinburgh, so we like to invest, or what we say, growth at a Scottish price. We don't like to pay fanciful valuations for things. And we know that in every market cycle, there is a fad. So whether it is the TMT bubble in the 2000s, or real estate infrastructure companies in 2007, or loss-making new age companies during COVID, we know that these fads typically get found out, and we are happy to stay away from them, even if that means short-term pain. The focus of all of this is capital preservation. As they say, to finish first, you need to first finish. And that is the essence of our investment philosophy, to preserve your capital and then to grow it sensibly over the long term. Now to the point about what we do differently from others. The difference for us is the focus on what we will not do. For most of our peers, what we will not do means avoiding certain sectors, whether that's armaments or casinos or tobacco. We do all that as well. But for us, first and foremost, it always starts with the people. This goes back to our founder, Angus Tulloch, and his philosophy that if you get the governance or the G right, in most cases, you will get the business performance, the environmental and social performance right as well. So we focus on finding those majority owners or those management teams that have a track record of treating all stakeholders fairly. So if there's a management team that doesn't pay its taxes, or there's a management team that doesn't treat its workers correctly, or has done things to the environment which are abusive, in our view, one day they will compromise interests of minority shareholders as well. For us, those businesses are simply uninvestable. So to give you examples of this are some of Asia's largest companies. In India, the Ambani or the Adani groups, which you may have heard of, or some of the Korean chaebols. Now, these are very large and successful groups. But when we go on the ground and we talk to their customers, suppliers, distributors, what we have learned over time is that they have built their businesses in ways that are unsustainable. Whether it is through regulatory arbitrage, by compromising the interests of various stakeholders, or by twisting or turning the rules in their favor, they have built their businesses which we believe is not sustainable over the long term. So to give you an example, the Adani Group in India, we have been meeting the group since 2007. And right from our first meeting note there, when we did checks on their reputation on the ground, we concluded that given how poorly people in their community thought of the group, it was not investable for us. So irrespective of how attractive the growth may be or how cheap the valuations may become, if the business hasn't been built in the right way, in our minds, the value of that business is zero. So how do we go about our process? We meet over 300 smaller companies in a year. We do over 1,000 meetings as a team. And in each of these meetings, we try to assess the culture of a company. So let me talk you through what this might be. So if we walk into a company's office, and it's a small cap, say $100 million, but the car park is full of Ferraris and Lamborghinis, that raises questions for us. Or if we walk into the CEO's office and we see a range of photographs with politicians, with film stars, that tells us something of what is driving that CEO. We also do reputational checks with their customers, their suppliers, their distributors. So if a supplier tells us that this company habitually delays its payments, or a distributor tells us that just before the end of the quarter, they ask them to take on a lot of inventory at favorable terms so that they can show good numbers, That tells us a lot more than financial statements that can be downloaded by anyone from Bloomberg. And finally, in every meeting, we engage with management teams on a range of issues, whether it is capital allocation, whether it is the composition of their board, or a range of environmental and social issues. We don't necessarily look for management teams that agree with us. What we look for is whether they are willing to listen to the feedback from a stakeholder. Are they cognizant of the risks? Do they want to learn and improve? Or do they simply dismiss the risks as something that is irrelevant? Because that tells us how they will treat other stakeholders as well. We obviously want to invest in businesses that are run by management teams that have a long-term view in terms of the risks towards their business and are willing to learn and improve. Now moving on to the way the portfolio is positioned. We tend to find more ideas on a bottom-up basis in markets like India, China, Indonesia, and Philippines. These are all large populations, young countries with aspirational populations, and as per capita incomes are rising, consumption patterns here are changing. We tend to find that with these consumption patterns changing, a number of smaller companies have the potential to be large companies of the future. We don't find many ideas in the likes of Korea and Taiwan, unfortunately. In Korea, the reason is, simply put, the governance standards tend to be very weak, both from a minority shareholder perspective, as well as the behaviors we see with most listed companies and families. In Taiwan, we find that most of the smaller companies have very limited bargaining power with either their large suppliers like TSMC or their large customers like Apple or Samsung. So these smaller companies end up becoming contract manufacturers that typically earn low returns on capital employed across the economic cycle. From a sector perspective, we tend to find a lot more ideas in consumer industries because they tend to be consistent and predictable. And we find fewer ideas in cyclical industries, simply because we as a team don't believe that we have any edge in trying to time different industry cycles. This is evident in the top 10 holdings of the portfolio as well. These are mostly across India, China, Indonesia, and Philippines, and mostly in consumer sectors. Most of these are companies that are held in the portfolio for at least 7 to 10 years now. I will now talk you through a couple of examples that bring to light our investment philosophy. The first one is the largest holding of the portfolio, Colgate-Palmolive in India. Now, I don't need to introduce the business to you. Everyone knows Colgate. The parent, Colgate-Palmolive, owns over 50% of the company. This company has had dominant market share of over 50% of the Indian oral care market for several decades. That has given it phenomenal pricing power. You won't change your toothpaste if the price increases by 2 or 3% a year. What it has also given it is strong bargaining power with its channel partners. So its inventory is typically funded by its channel partners. Because its inventory is funded, because of the high margins it earns, the return on capital employed for Colgate is consistently over 100%. It is one of the highest return on capital businesses in our portfolio. Now, the opportunity for oral care in India has always been large. Per capita spend on oral care is less than $1, compared to over $5 in China or over $10 in Brazil. But for a number of years, Colgate in India had not invested enough in market development. New competitors emerged and their growth slowed down. The parent recognized this issue 3 years ago, and they brought a new CEO from Unilever, Prabha Narasimhan, who began to invest aggressively in revamping the growth. So she began to introduce a lot more new products. She began to invest a lot more in brand building. That has helped Colgate start to regain market share in recent years, and its growth has accelerated. Along with that, the opportunity it has is in categories that are beyond oral care. For its parent, oral care is only 60% of revenues. But for Colgate in India, oral care is over 95% of revenues. Prabha has been changing that by introducing a number of new products in categories like Palmolive body washes. That is another significant area of growth for Colgate in future. So we have a company that has a significant runway of growth. Its revenues for a population of over 1.3 billion is only $800 million. This can be several times its current size. And with it comes return on capital of over 100% and consistent and predictable growth. It doesn't matter if we're in the middle of a pandemic or a war or the global financial crisis. Each of us, unfortunately, still needs to brush our teeth. That is why we are so confident of Colgate and why we believe that it is going to have a very attractive future ahead of it. In the interest of time, I will briefly touch upon a couple of changes that have taken place recently. Firstly, the mandate has included investments in Australia, New Zealand, and Japan in recent years. We believe this is beneficial as it has increased the investment universe for the trust. We have bought our first holdings in Australia and in New Zealand. What the board has also done is to implement long-term structural gearing for 20 years at a very attractive fixed rate of 2.75%. In the past, the trust has had gearing, but that has been more tactical in nature for short periods. And because we as a team don't believe in timing markets, in most cases, this debt was repaid early. In this case, it is structural gearing aligned with our investment philosophy over the long term, and that is why we believe it will create good outcomes for shareholders. Here we see how the portfolio has evolved in recent years as well. I will broadly touch on three things here. Firstly, the portfolio has become a lot more concentrated among the top holdings. So the top 10 has gone from 25% to 45% now almost of the portfolio. Secondly, both the return on equity as well as the earnings per share growth of the portfolio have improved consistently. In our view, that reflects a portfolio that is much higher quality, that is much more resilient. And finally, in terms of valuations, for a portfolio that is more consolidated, has higher growth, has better ROE, the valuations are similar to what they have always been in the past. If I think about this as a single business that is earning a return on equity of 19%, that is growing its earnings per share at 17% annually, and is available at 18-19 times forward PE, we would be very excited about finding that business. That is why we are so confident about the portfolio today. Finally, I will touch on what you should expect as performance outcomes as shareholders of the trust. What this shows you is the batting average of the trust since inception. You will see that in very heady markets or strong periods, we typically don't keep up with market performance. But it is in difficult periods or down markets that we tend to do better almost 80% of the time. That is what helps us do better across time periods by preserving capital in difficult times. Sorry, I think it's gone further ahead, but the last point I want to leave you with is since inception in 1995, in every year of negative market returns, whether that is 1997, 98, 2000, 2008, 2018 or 2020, the trust has performed better than the index. That is the focus on capital preservation. Now, to leave you with a summary of everything that we've discussed, this is an investment philosophy that has remained consistent since inception, with the same team, with a focus on owning smaller companies that are run by people we can trust, who we feel aligned with, businesses that earn high returns on capital, and smaller companies that have the potential to be the large caps of the future, with a focus on capital preservation. In difficult periods, preserving your capital and growing it sensibly over the long term. This is the investment philosophy and process that has stood the test of time for us. Thank you.
Thank you, Sree. That was a really excellent presentation. We do have a few minutes for questions, and we have one here on the front row. Thank you.
Thank you for your presentation. I'm a little bit confused because you've invested in Colgate, which is 11 billion, and I thought you were small companies under 4 billion. And my second question is, you don't have very much in Vietnam. Is that because you're not finding too many opportunities there? Because Vietnam is seen as the fastest growing economy in the Southeast Asia region. So you have very, very little there. So
Absolutely. So thank you for both the questions, very valid. So firstly on Colgate, the mandate of the trust is to invest in companies below $5 billion of market cap at the time of first investment. What that means is that if we buy something that's below 5 billion, and that has been a successful investment, we are not forced sellers of that company. So if we buy something at 4 billion, and for some reason it succeeds, we shouldn't be forced to sell it at $5 billion. And we have been invested in Colgate, as a matter of fact, for almost a decade now. It has been a very successful investment. Because of the long-term opportunity that we see ahead of it, is why we feel comfortable owning it today. It is actually also the largest company in our portfolio by market capitalization. So you won't find many Colgates in our portfolio that are larger than 5 billion, but it is one that has been successful. And because we are confident about its long-term growth, we don't want to be forced sellers of that business. And the mandate allows us to do that. In terms of Vietnam, it's a question that has been asked a number of times. We visit the country several times, at least once a year. The problem that we have faced in Vietnam, to be honest with you, is that we don't find a number of well-governed, high-quality, listed companies. So Vietnam is growing very fast, partly because a number of companies from outside Vietnam, so textile manufacturers in China or electronics companies from Korea or Taiwan, are setting up manufacturing in Vietnam. But those companies aren't actually listed in the Vietnamese market. They are listed in Korea, in Taiwan, in China, and so on. So we are shareholders of some businesses which have operations in Vietnam, part of their operations there, but are actually are listed in other markets. So Sinbon Electronics in Taiwan is an example of that. But fewer companies in Vietnam itself. The second issue is we have found it difficult to find a number of well-governed local businesses there. Part of the reason being that a number of companies in Vietnam came about as the owners of those companies were ex-state-owned managers, and they were given their stakes in those business through either favors or licenses that were achieved in means that were maybe not completely scrupulous. Some of the business practices there aren't high quality. Companies investing, a listed company with operations in one sector investing in real estate, politicians having stakes in a number of companies. A few governance scandals have come to light in 2022, 2023 as well, which have raised challenges and question marks on a number of groups in Vietnam. We have been long-term shareholders of a company called FPT Corporation in Vietnam for almost a decade now. We find that the governance standards there are very high quality. They have built a globally competitive business. We have a few other companies on our watch list in Vietnam as well. But for a combination of reasons, maybe conviction in the business, valuations, etc., we're still monitoring how they are going, and they haven't made it to the portfolio as yet.
I'm really sorry, we won't have any more time for questions, but perhaps if you're hanging around for a bit, Sree, you're not going back to Singapore straight away. There might be a chance to chat afterwards. Thank you very much.
Thank you.